Okay, class, let's get started on chapter 6. This is a really good chapter. It's dealing with receivables and it's also dealing with inventory. This video is going to deal with the receivables, and then I'm going to have another video that's going to deal with inventory. This video, the receivable one might have to be a two-part. We'll just see as we get along with this chapter. Okay, the first part talks about what an accounts receivable is. Just simply, it's when somebody buys something from the company and they're buying it on credit. So accounts receivable just means they owe us money. A notes receivable typically is when somebody borrows money and they sign an actual note, a document saying, I'm going to repay this amount of money over this time period at this interest rate, make payments at this time. So that's what a notes receivable is. The chapter does a very good job of explaining the notes receivable, and then it shows how they calculate interest. You're going to be calculating interest on your homework, so make sure you read through that. I'm not going to go through that because I think it's very simple and well explained in the textbook. The accounts receivable is a little bit more difficult though, so that's why we're going to lecture on that right now. So I put some information up here. Sales of 1 million. So that was our sales for the year. At the end of the year, we have an account balance and accounts receivable of 100,000. The allowance is negative 2,000. Now it could be a positive number, it could be a negative number. Now the allowance is money that we have set aside, a dollar amount that we have set aside for those people that we estimate are not going to pay us. And then there's two different methods, percentage of sales and percentage of accounts receivable that we're going to be looking at. First of all, if we have a balance of 100,000 in accounts receivable, are all those people going to pay us? Well, we know from experience, especially right now in today's market, that no, not all these people are going to pay us. So we can't have this on our books, just 100,000 of accounts receivable, because it's not accurate. We have to have an allowance, something set aside for those people that aren't going to be paying us. Okay? So you can directly write off these expenses, but most businesses don't do that because accounting doesn't allow them to do that. A direct write-off method would just say, look, you call somebody up, they say they're not going to pay you, and you just expense it. You get rid of their accounts receivable, so you decrease accounts receivable, and then you increase the expense. You recognize the expense. Okay? So there's our transaction. If someone owed us $5,000 and they say they're not going to pay us, get rid of the accounts receivable for $5,000 and recognize a bad debt expense or a doubtful account expense of $5,000. That's called the direct write-off method. That is not the method we use. Okay? Very small businesses or companies that don't write off a lot can use the direct write-off method, but that is very rare. Most of them use the allowance method. So that's what I'm going to introduce right now. The first allowance method is the percentage of sales. Okay? Now you would never do both. You would do one or the other. Okay? But there's just different methods we can use. The percentage of sales method says, okay, we're estimating that 1% of sales are going to be uncollectible. 1% of our credit sales. Where our total sales for the year were 1 million. So 1% would be 10,000. So all we do is we recognize an expense, bad debt expense. Let me just double check, make sure that's what the different textbooks use, different accounts here. Yes, they're using bad debt expense. So I'm just going to say $10,000 because 1% of a million is 10,000. So that's I got the 10,000. So we're going to have expense of 10,000, and then what we do is we increase our allowance. So we're setting aside a dollar amount. We're setting aside a dollar amount for those people that aren't going to pay us. Well, there was already a negative 2,000 in there, so we're putting another 10,000. So the balance is going to be 8,000 now because we'd already gone over it last year, so by 2,000. And we're putting another 10,000 of allowance in there. So the balance at the end of the year would only be 8,000. Okay? That's the percentage of sales method. It's very straightforward. Okay? Now, the other method is the percentage of accounts receivable. Well, the textbook shows using the aging approach. The aging approach. And I don't have time to go over the whole aging and how it's calculated. The textbook does a very good job on the aging approach. It's Exhibit 2 in the textbook. They have an estimate of uncollectible accounts. It shows there the balance in the accounts receivable, the percentages, and then it shows when they take those percentages times the balance, what the amounts are. And we're just going to use the number there. It doesn't really go along with our example really well, but it goes along well enough. So there it says $3,390. So that is the aging accounts receivable, okay? So what we're saying is this percentage of the total accounts receivable based on aging, $3,390, is what we want our ending balance to be, okay? So there's a difference. When we're using percentage of sales and we take that 1%, that's the adjustment. That's the dollar amount that we're gonna increase expense and increase our allowance by. When we do it based on accounts receivable, that is not the adjustment. That is what we want the ending balance to be. Well, let's look at the allowance. It's got a negative 2,000 in there. So the adjustment then is, so we're gonna have our expense and our allowance. The adjustment would be 5,590. Okay, and then we would increase our allowance. So when we increase our allowance 5,590, and there's already negative 2,000 in there, it gets us to where we want to be. Once again, I'm going to reiterate this. There's two methods. There's the percentage of sales, the percentage of accounts receivable method. When we do the percentage of sales method and take that percentage, that one's a little bit easier because that is our adjustment. When we do it based on percentage of accounts receivable, we use the aging just now. That's not the adjustment. That is what we want the ending balance to be, so we have to look at the allowance and back into the adjustment. Now, there's a third way too to do this, and you can see right here on the board, you're probably wondering, well, why does he have this percentage of accounts receivable 8%? Well, I have this because that's another way to do it. Just taking a percentage of the accounts receivable. In this case, that percentage is 8,000. 8% of accounts receivable would be 8,000, okay? So let me write below here, I'll put down, there's also the aging method. So there's really the sales method, and then there's two accounts receivable methods. There's the aging one that we just did, and then there's the percentage of accounts receivable where I got my 8%. So how are we gonna do this? Well, it's based on accounts receivable just like the aging one. So that 8,000, we have to look at what our balance is there. It's a negative 2,000. We want our balance in the allowance to be 8,000, so then our adjustment will be 10,000. Okay. Little bit tricky because we've got percentage of sales, the accounts receivable aging, and percentage of accounts receivable. The sales gives us, like I said, I'm going to say it one more time, the sales gives us our actual adjustment. How we're going to affect the expense and the allowance. Accounts receivable aging, percentage of accounts receivable, that gives us what we want our ending balance to be in the allowance account. So we have to back into what our actual adjustment is going to be. Okay, now let me talk just a little bit more about this. The allowance, once again, is the amount that we have set aside for those people that aren't going to pay us. So when somebody comes in and says, we're not going to be able to pay you, okay, and you're using this method right here, the percentage of accounts receivable, in fact, any of these allowance methods, there's no effect on expense when they don't pay us, because the expense took place when we estimated those people that aren't going to pay us. So when somebody actually doesn't pay us, there's really no effect, because what we're doing is we're decreasing the accounts receivable and we're also decreasing the allowance, okay? Let's just take a quick look at that. So our accounts receivable right now is 100,000 and our allowance, now I've been saying it's 8,000, but it's called a contra asset because it offsets our accounts receivable, okay? So when we're using percentage of accounts receivable, the balance is 8,000. So this gets us a $92,000 balance, okay? Let me point out again, this allowance offsets accounts receivable, so our net accounts receivable is 92,000 because we've set aside 8,000 for people who aren't gonna pay us. Now, we called somebody up, they said they're not gonna pay us, they owed us $1,000. So what happens? We don't expense anything because we already expensed it. What we do is we reduce accounts receivable by 1,000, but we also reduce the allowance by the same amount. So what happens, our entry balances out because we have 1,000 and 1,000. One's increasing, the other one's decreasing. So what happens is we still have a net 92,000, which is what we want. We don't want the net accounts receivable to change at this time because we already estimated when these people weren't going to pay us. That took place last year. This year, when they don't pay us, it's not going to have any effect on our income statement or balance sheet, except just decreasing our accounts receivable and then decreasing the allowance, which has a net effect of 0. Okay, this is kind of complicated stuff. You're probably going to have to read through this chapter a few times. You're probably going to have to read and listen to this lecture maybe a couple times. All right, well, good luck with the accounts receivable, and we'll talk about inventory in the next video.